Well, yes, in fact, I'll toss it across to Mithali. Ladies first. Mithali, go for it.
Right, so HDFC Bank, that stock has not given returns to the investors for 5 straight years, giving flat returns. And if you talk about the growth, so advances, they have nearly grown around 12% on a CAGR basis. That's healthy, but it's hardly exceptional for a bank which is having such a heavy weight in Nifty 50. Don't you agree?
No, that's true, but there are a set of problems. During the time of merger, what happened was liquidity was constrained, and there was a need for HDFC Bank to replace liabilities, which is the current borrowing, with deposits. That hasn't fully happened as quickly as one was anticipating, and therefore the growth is slower. But now that has started to play out. You can see from 18% in terms of the liability book, it's now at 11%. That's the borrowing book now. So some replacement has happened, some way to go. If they fix that, you could probably see loan growth pick up.
What about the margins? The margins have been under pressure since the merger. Management has been constantly guiding that they will be improving margins, but still at 3.5%, 3.6%, still below the pre-merger levels. And they are not able to translate all that growth that you mentioned. They are growing, but that is not being translated into the margins per se.
Still a function of the borrowing number, right? So if borrowings come down, margins start to inch upwards. That's not happened in a significant fashion, and therefore you've not seen that margin inch up. Also, what they've done is they've lent to the more secured category and to wholesale lending. That's where they focus. Once retail starts to pick up in terms of their loan book growth, you'll start to see margins recover. But that's not happened yet. It could well happen in the next year or two.
Let me talk to you about the earnings. So HDFC Bank is a company which was promised to deliver 20% business profile. But if you see for the last 3-4 years, that 5% EPS growth, that gives a different business profile for HDFC Bank. So not margins, not EPS. The growth, I think it's a long way for HDFC Bank even for now.
If the margins turn, right, say currently margins are at 3.26. If margins turn towards 3.4, 3.5, maybe even 3.6, if that were to happen, of course, it's a large bank now, you will start to see EPS kick through. Yes, EPS has disappointed. But if margins recover, that's really where the function lies. And if margins recover, you could well see EPS recover as well.
There are so many ifs in your conversation because all this is a story of promises. And again, talking about the governance issues, that has been a problem for HDFC Bank. The Tanu Chakrabarti case that wiped off nearly $21 billion in a straight, and just based on this ethics and values that he quoted. And again, the MSRDC case, again, putting the concerns on governance. So yes, if you see the valuations, they have been discounted just because markets are discounting based on the trust and the governance issues at HDFC Bank.
But there's a clean sheet given, right? You've got your internal review, which is done. You've got an audit done, and you've largely gotten a clean sheet with regard to all of these matters. There's no mala fide intention, and therefore, likely, governance should stand, and HDFC Bank is known for governance. But let's talk about FIs, because that's been the other, key concern with regard to HDFC Bank. Actually, FIs have withdrawn out of India in a big fashion. We're at decadal lows where FI holdings in India is concerned, and which is one of the reasons why we've seen the stock perform the way it has. So therefore, if FIs were to come back, which is the argument which many investors are making at this point of time, you could well see inflows come into the bank.
But my question is, why HDFC Bank? There are many other pools for the FIs to invest in terms of valuation, in terms of growth perspective. Every aspect, if you see HDFC Bank, I do not think gives those promises even to the FIs, although they are underweight. But FIs, I think they will be building on a long-term story and not just that underweight perspective that HDFC has been seeing.
Well, very possible. Let me also talk a little bit about valuations. Valuations are now severely discounted. This 1.9 time book that you're seeing on your screen, the 1 year forward is at 1.7. And if I remove the subsidiary valuations, it's actually at 1.5 times the 1 year forward price to book on a standalone basis, removing subsidiaries. So it's looking, terribly cheap versus its 10-year average, of course, of 3.5 times book on a console level. You're seeing HDFC Bank available at a 50% discount versus its 10-year average.
Again, my argument, those premium valuations were given to HDFC Bank because of the earnings, the growth that it had delivered. But now, since you know that the growth has been sustained, they are not able to deliver. So yes, the cheap valuations, because they're not able to deliver and because those promises, they're actually not actualization or materializing in their books per se. So yes, discounting just because whatever the investors are seeing, they're not able to bid and trust HDFC Bank for longer. And yes, they are disappointed. The streets are disappointed. Such a heavy weight in Nifty 50 and no returns for such long years.
Well, that's our case. The bull versus bear on HDFC Bank.